Right, it's 9:30, so welcome to today's meeting of the local pension committee. The meeting is being broadcast via YouTube and also available for viewing after the meeting. Due to the current situation, the meeting will take place virtually with members of the committee along with officers presenting reports joining online. Can I please ask that all members and officers have their microphones on mute until they wish or are invited to speak. When you're speaking, please turn on your video. Could I ask then for those present to introduce themselves to those watching online? I'll start off. I'm Peter Osborne. I'm the current chairman of the local pension board.
How do we want to do it? I'm Marius Graham. I'm the Borough Council representative from Melton Borough Council.
I'm Tom Barclay. I'm the County Councillor for Syston Ridgeway and Vice Chair of the committee.
I'm Peter Bedford. I'm the County Councillor for Markfield, Desford and Thornton.
I'm Sarah Hill. I'm County Councillor Market Harbour East.
I'm Councillor Ratilal Govin, represent City of Leicester.
I'm Nick Booth, staff representative.
I'm Nick Booth, I'm staff representative.
Okay, thank you very much. I don't think we've missed anybody out. On the, if I could go on to the agenda, I propose that the minutes of the meeting held on the 22nd of January are taken as read, confirmed and signed. Are you all in agreement?
Yes, Chair.
Yes, Chair, yeah.
Okay, thank you. Question time. I've received no questions. Agenda item 3, questions asked by members under standing orders 7, 3 and 5. There are none. To advise of any other items which the chairman has decided to take as urgent, not elsewhere on the agenda, I've not been notified of any urgent items. Could I ask then for the declaration of in respect of items on the agenda? So I'm asking members if they've got any interest which they should declare. No, okay. Okay, then we move on to the
Chair.
Sarah's got.
I'd like to. Aegean are my pension provider or platform provider. It doesn't really affect it, but given that they're given a report, I think it should be noted.
Okay, thanks. Right, then we'll move on to the substance of the day's agenda, and that's on agenda item 6, the disapplying the public sector exit payment gap. And I think we're joined by Ian Howe.
Good morning, Chair. Good morning, everybody. I'm Ian Howe. I'm Pensions Manager for Leicestershire County Council. This report is just to inform the committee of an amendment to the direction that government were taking in terms of the public sector exit cap. Just a little bit of history very briefly. The exit cap was introduced on the 4th of November 2020 after a 4-year consultation. And this was effectively to introduce a 95,000 cap. There was a number of sort of far-reaching implications of the introduction and the proposed further changes that were proposed by government, and effectively that created a number of judicial reviews being lodged by a number of parties that were due to be heard in March this year. But on the 12th of February, earlier this month, government announced that they were disapplying the exit cap with immediate effect. So we had to quickly change the process for those cases. I'm pleased to say there were there were no cases where members actually breached the 95,000 cap in the Leicestershire Fund and subsequently retired. So there are no respective benefits to be calculated, but there are a number of administrative changes that are required, which we're working through. And we have written to all the fund employers, and the few cases that were due, which had been done as estimates, we've worked through those with the employers. But as I say, none of them actually did subsequently retire, which is good. The final thing I did want to mention, though, on the same day, on the 12th of February, HM Treasury also issued guidance. And I think it's important we just make this known to the committee. The guidance stated it's still vital that exit payments deliver value for the taxpayer, and employers should always consider whether exit payments are fair and proportionate. HM Treasury will bring forward proposals at pace to tackle unjustified exit payments. So whilst we're back in the position prior to the 4th of November, we do expect further changes will follow, and we have informed the fund employers of that. And that's really all I was due to say, Chair, but I'm happy to take any questions.
Does any member have a question for Ian? I can't see anybody asking to go. So thank you very much, Ian, for giving your report. Members are asked to note Ian's report, please. Moving on then to 7, the pension fund budget and business plan for the forthcoming year. That's for Declan to introduce.
Thank you, Chair. The report is just a summary, really, of the kind of the budget, and also the sections business plan, which is the administration section primarily, which Ian looks after. So Ian's going to sort of stay in the call in case there are any questions of detail. I was just going to talk through the main report rather than the full sort of business plan, although obviously happy to take questions on that. And just one point to highlight, the report's a little bit out of date. Apologies. It has already been taken through the board, and the board didn't have any sort of new comments on the report, so it's just kind of coming here now for approval, as it were. The key changes in the report since last year that have been reflected in the budget is one is a review of the pension section itself. So that's the administration section that look after kind of the, us as members of the fund and also the retired pensioners, which has resulted in a new structure for the fund. And a key part of that sort of new structure was the implementation of the McLeod remedy. Members will remember this is around the kind of the age discrimination sort of ruling that sort of government lost. So it was probably last year has resulted in a whole load of retrospective work where in truth it's going to be over a 10-year period that people could have sort of dual calculations of the pensions. So it's not a surprise that it knocks onto the administration section in there. So we're going to try and deal with that with a relatively small kind of temporary team that kind of gets on top of that work initially. Just, I suppose, one point of language, and as I appreciate it'll be different across different organisations. When we normally talk about reviews at Leicestershire County Council, and I'm sure other organisations are the same, it tends to look for a reduction in costs, but this hasn't been the case for the pension funds. The pension fund obviously does benefit from that sort of separate funding streams through sort of, the county council, city council, and all the other employers. So it is sort of slightly different. You're not sort of impacted, historically by austerity or sort of demand pressures, as it were. That said, we are still conscious that it is public funding, so you do need to keep the costs as low as sensible. And I do stress that word, sort of sensible. So the pension fund, is cognizant that each employing body is under sort of financial pressure, but at the same time it has to strike that balance between providing a sort of a good administrative and investment service as well. So just turning to the page at the top of table at the top, page 17, and apologies again, second mistake in the report. If you noticed, everything's £0 and now it should be £1,000. We haven't spent kind of several billion pounds. So apologies for that. That's sort of two errors so far. I'm not doing so great. The top half of that table is sort of investment management expenses, and that's really sort of strongly driven by the kind of the level of assets. The amount normally managers charges doesn't change too much, although the fund does benefit from a certain level of kind of fixed kind of costs. So as the asset goes up, the cost doesn't go up, but most of the big numbers are on a percentage basis. The transfers that we're making to Central, and it is quite sort of a fairly slow rate, we're only doing sort of 1 or 2 transfers a year, is gradually starting having an effect, but the level of assets each year is quite small. If you think the last one we did was quite big in terms of the climate funds, but that was pretty much a wash because we were doing that for other reasons as opposed to investment funds. But the one before that, the emerging markets debt, was the only one we did in the year. It was only £100 million. It's gradually building up, but it is fairly sort of slow at the moment. And a lot of these initial benefits that we're getting are offset by the transition costs. As you buy and sell a lot of assets, you do incur quite a few fees, and actually to some extent you impact the markets as well. So you can kind of cause sort of price inflation or deflation. But we do expect that to come good over time. For the funds that they have launched that we've transferred into, the sort of savings we're seeing is about 25%. So it is pretty good. Obviously, kind of as you see in that table, you're still seeing the kind of the assets going up, and that's really driven by the kind of the assets of the fund. You know, as I mentioned before, the costs are driven on a percentage basis. So as the fund grows over time, you end up paying more to your managers, unfortunately, as well. And the next sort of significant line in there is LGPS Central itself, and LGPS is split into 2 parts really. Sort of the hidden within those managers' costs is the sort of the charges that are driven by the assets under management. So we pay for that sort of separately to the governance costs, and that governance cost relates to us as being an owner of the company, and it obviously gives us the influence over that. And the governance costs tend to be the sort of the staffing type costs, you know, the sort of the board infrastructure and some of the kind of that sort of back office overhead, as opposed to the front line kind of LGPS Central gets paid on a pay per play basis really. As you use it, the more the more you pay. And the budget's I did touch on this before, didn't I? Not third one. So the budget has been approved. This is the third mistake. It has been approved by LGPS Central at this sort of stage. When it was taken to the board, it hadn't quite been. So it tends to be a kind of, as owners of the company, we're directly involved in that approval of the budget. So that basically the way it works is that the company do a proposal, people like Boulesh are involved in kind of giving the company a bit of a hard time initially, and then it comes to Peter and his sort of peers across the sort of the other owners to kind of then sort of have sort of further challenges and either approve or decline that sort of budget as they see fit. And it is a key part of our sort of ownership of LGPS Central. And it's easy to forget that, you know, we do own Central rather than sort of, you know, your LGIMs and all your other ones we've got much less influence over. So it is a key event of the year, the budget setting, and it's probably an event where kind of the tensions between kind of the public sector owners and the kind of the private sector kind of company kind of come to the foremost, and it's relatively healthy tension, and that you kind of need to get that sort of the alignment of expectations. You know, obviously kind of we're wanting to kind of eke out the sort of the savings from this, but at the same time being cognizant that the performance is everything really, that we don't want sort of bad products, you know, obviously sort of and the sort of Central may have a different view of how they go about that. So it is a key part of the year where we're trying to find that balance between a major recipient of services from Central versus that sort of ownership duties as well. And like I say, it's probably the tensest part of the year, but it has been kind of, I suppose people are getting into sort of the stride with it now. The next part of the table picks up on the staffing budgets. You'll see the kind of the increases. I mentioned before the McLeod, and that's why there's a bigger increase in 2021-22. And other costs you can see are sort of either being held or kind of it's only going up on a sort of inflationary basis. You can't tend to always avoid inflation, no matter how much we'd like to. You'll see the actuary cost is the main one that spikes in there, and that just reflects the triennial valuation. It's a huge cost that we do pay for that valuation. But then if you reflect on it, and we've got over 200 employees in the fund, you can see that kind of there is quite a lot of handle turning the actuary has to do to kind of, you know, make sure all that sort of information is produced. But it is an expensive service. Just wanted to highlight in terms of potentials and certainties, the actuarial service is out to tender at the moment. So Ian and his team are going to be assessing the kind of the returns on that. So that's one that, you know, hopefully it'll be sort of downward pressure rather than upward, but you never know. We haven't tested the market for a little while, so that is out to tender at the moment. The final line there, you see the percent of assets under management. Obviously, that's one we keep a bit of an eye on. That you do expect that to continue to decline. As partly as the fund grows and you get economies of scale, but also the work from central. We do want to keep seeing that percent of assets under management, so that as you as employers kind of put money into the fund or the investment returns come in, more of it's direct into the pensions as opposed to either administrative or other overheads that are coming through. So that's all I was going to say on the fund, and obviously there's this section, the service plan attached as well. So happy to take any questions.
Before you take any questions, could I just ask Claire Scott if she has any comments as our independent advisor? Are there any comments on the report she'd like to give?
Yes, Chair, thank you. Just a couple of points, really, just thinking forward on the transaction costs. I think best to think about these in terms of sometimes there's ongoing transaction costs in terms of ongoing mandates and buying and selling of stocks, whereas there's the different, more chunky transaction costs of actually moving full mandates, which we've seen in recent years moving from previous managers into central. So perhaps, and maybe it's a question for the officers, is maybe we might see those transaction costs going down in future. Perhaps that's one question. And another observation is in terms of the plan and the action plan for the year. It mainly covers the pensions administration. And I'll just make the observation in terms of good governance reports and the recommendations to the Scheme Advisory Board will be around thinking about the funding in totality. So in future, again, I would recommend that the investment plans to be considered in the overall plan and the resourcing to be considered accordingly as well. So happy to take any questions as well.
Okay. Are there any questions from members to either Declan or to Claire? Nick.
I think you've got Nick.
Yeah. Yeah, Declan, how do our costs compare with other pension funds?
It's been a mixture in terms of you definitely see a sort of scale difference. So when we went into the pool with sort of West Midlands, some of them had sort of clear daylight between what we were paying and what they were paying. And if you think about sort of West Midlands fund was kind of, Bulish might correct me, but I think they're sort of 2.5 to 3 times the size of us. So you do expect that kind of daylight. But to be honest, on the other ones, they were pretty good. Colin, in fairness to Colin, that was one of his strengths of not being sort of shy to kind of give investment managers a hard time. So the historic stuff has been pretty good. And some of the kind of I think the very first transition we did on the global one, we didn't get this. The payback on that was 5 years because our base level had been held at quite a low level, and Colin had pushed quite a bit on having fixed cash amounts rather than percentage increases. So obviously the percentage charge was gradually declining over time. So in truth, not too bad, but we are seeing really good kind of improvements from central. And like I think I quoted, so 25% seems to be the rough sort of figure that they're coming in at the moment with the reduction, so which is very good.
Okay. Any other questions? Obviously, this being at the heart of what we do with the fund is the budget, and as we migrate more and more of our assets to the central pool, I would strongly urge my successor and all members to remember that whilst there is the difficulty of the board coming from the experience of say the city, and we come from the experience of local government, there is sometimes a tension between the two, and I just would like us to remember that we are actually, along with 7 others, we are the owners of the pool, and we should exercise the responsibilities that go with that. However, that was just my parting shot, because it's the last time that I'll have the chance to say that, because Tom and I have, with other members, other shareholders, emphasised to the board of our concerns. Anyway, if there aren't any more questions to Declan and Scott.
So sorry, Peter, just one point on that, you just to sort of let the committee know that you did raise before the meeting about kind of having an update on the savings in terms of central, and we are sort of a couple of years now into pooling. Although it's been a little bit slow, the products are starting to launch. So we will bring to committee this year just an update of how the sort of progress on savings is getting, because with the 15-year kind of payback is what was envisaged at the start of the process. The chair's absolutely right that you have to keep an eye on the cost, because you don't want that sort of payback to just kind of push out indefinitely in the future. So we will bring a report back to the committee just to update you to how the savings objectives are going.
Okay, could I ask members then if you approve the pension fund budget and business plan for 21-22? Is that agreed?
Agreed, Chair. Agreed.
Okay, thank you very much.
Agreed.
Right, on to the pension fund policies update. They're set out on pages 29 to 80. And again, that's across to you, Declan.
Thank you, Chair. Hopefully a fairly straightforward report. The three policies that are sort of included in the paper are sort of it's only been sort of minor tweaks, which tends to be the sort of the case. We tend to have sort of maybe on a triennial basis, or when there's a change in legislation, do bigger changes, but then just keep an eye on them throughout over the course of the year. So I won't sort of spend too long on it. So the first one is the administration and communication strategy update, and it's kind of really sort of the interface with the various fund employers that is key here. And you'll see there's a couple of changes just in terms of terminology. What iConnect is basically how the managers, employers all submit their kind of payroll information into Ian's team, so that then they can process it and make sure pension sort of entitlements are calculated correctly. And what iConnect does is kind of just reduce a lot of the manual intervention required, automates a lot of the checks, and it's kind of it's had good progress so far, but I mean, you can imagine how it's been. It's kind of an IT change for managing employers, and across kind of the impact of COVID, people can't sort of adopt as quickly as maybe their first thought they could. So it's just a delay on that, but it's good progress so far, and it's been beneficial in terms of that sort of administration of the scheme, both from a kind of an efficiency point of view, but also a data quality point of view. And the second one, the independent governance review, that's a sort of a name check to Claire. So just so she knows, we do listen to her to just sort of some of the changes suggested have been reflected in the policy. That I think we brought that in January, sort of the summary of what had been suggested. And the investment strategy statement, obviously a key document. We did a big update last year on the document. So this time round, it is just a bit of a they're reflecting the changes that were approved in January to the strategic asset allocation. So it's more housekeeping to that one. It's still sort of it's still seen as fit for purpose, but again, it's a key document we do keep an eye on each year. And then the final one was that it was only introduced for the first time last year off the back of kind of a Competition and Markets Authority looking at kind of was it sort of were people using advisors appropriately in value for money and stuff like that. So again, there kind of hasn't really been sort of any major changes to that. When we have finished with the actuarial tender, this is kind of the next cab off the rank, as it were, in terms of going out to tender. So we'll look at sort of what we do with the Hyman's investment advice side of things when we've got the actuarial side kind of buttoned down. So that may sort of drive some more change in here. But for now, it's just a bit of a kind of it's a bit of a check and an update and meet the sort of the requirements of the submission requirements. So that's all I was going to say on those papers. Happy to take any questions.
Okay, are there any questions? Malise?
Yes, Mr. Chairman. Just pages 43 and 44. What happens with the circumstances where costs might not be recovered? We charge £100 an hour. What actual penalties, sanctions have we got against people who do not contribute? Do not help us and contribute to us? Do we have any sanctions?
It tends to be fairly limited. Ian may come in a minute, but it is one of the frustrations often that the fund as a whole, hence it's all the different employing bodies kind of take the burden, but you are limited in terms of actual penalties or sanctions that you can put on people who've incurred costs. And unfortunately, you can sometimes really get the runaround as well, particularly sort of I don't know, an example might be kind of new employing bodies and sort of having to put a lot of administrative effort into getting them set up, getting the sort of right security and bonds in place, but you don't always recover the money. So I don't know if there's anything you want to add on there, Ian, but
Thank you, Declan. No, there isn't really, other than if an employer continues to fail and really does not meet any of its legal requirements, we do have the power to take them to the pensions regulator as a material breach. But in absolute honesty, I think the regulator would just push it straight back to the fund to deal with. So Declan's right, really. It's a bit of a difficult situation for us, in truth.
Thanks, Ian.
Would it make sense to put in a stronger sanction into the original contract, or not?
We have a legal duty to allow those employers in the scheme. We don't have an ability to stop an employer coming into the scheme. So that's the kind of the problem, if you like. The admission agreement that they have to enter into details all the legal requirements that the employers have to follow, and that does actually state all their responsibilities. So if an employer does fail, they are in breach of the admission agreement, but ultimately it still falls with the fund to then resolve that.
Right. Thank you very much.
Okay, Claire.
Thank you, Chair. Just on the administration policy, I noticed the deadline for the employers submitting data through the iConnect is moving for some of them from 21 to 22. And I just thought the committee might be helpful to get an update on whether that has any implications for member service, or particularly thinking about the annual benefit statement legal deadline at the end of August. Are you still comfortable that you're going to meet that deadline?
I'll let him pick that up.
Would you like me to come back on that?
Mm-hmm.
Yeah, we are, Claire. That's not something that gives me concern. We've had iConnect being rolled out now for 2 years, and we've met the regulatory position on annual benefit statements and pension taxation statements every time. So I don't envisage that being an issue. What I would say is, of the 77 employers still outstanding, as a percentage of the fund in terms of scheme membership, it's a really small percentage, because we've got the vast majority of the larger employers now on iConnect, which is really, really helpful, and that's really helped us through year end. The ones that are remaining tend to be the much smaller employers. Parish town councils are an example. A lot of the smaller admission bodies that maybe have 10 to 20 staff, and a number of the remaining academies as well, to be truthful. But the vast majority of the larger employers are complete. So if iConnect isn't in place for those employers, and it's unlikely to be by August for this year's annual benefit statements, we'll use the current existing process for those employers. So I don't envisage that being an issue, to be honest, Claire.
Okay. Right. Thank you very much then. If there are no other questions, you're asked, first of all, to approve the revised administration and communication strategy. Is that agreed?
Agreed, Chair.
Okay, the second, thank you. The second part is you're asked to approve the revised investment strategy statement. Is that also agreed?
Agreed.
Agreed.
And finally, we're just asked to note the submission of the fund's investment advisor, the objectives to the Competition and Markets Authority. Is that also agreed?
Yeah.
Agreed.
Okay, thank you. Agenda item 9 then, the risk management and internal controls report on 81 to 94 in your pack. Chris Tambini, Director of Corporate Resources, is going to introduce this report.
Thank you, Chair. This is the usual risk management update. There's not a lot I was going to add to the report. I mean, the good news is in paragraph 4 that we've actually removed a couple of risks from the risk register. I think members are aware that we've been trying to transfer the fire administration for probably a couple of years now, and we finally transferred it to West Yorkshire. There are some real advantages actually for the administration of the fund, because it means that we don't have to be on top of all the regulations and guidance that support the fire service kind of pension scheme. We can kind of focus wholly on the local government pension scheme. So that's really positive. And we touched on the other one that's been removed, which is we thought COVID could have an impact in terms of on our ability in terms of getting the annual benefit statements out. Although there have been some delays with some of the returns from some of the funds, we've managed to achieve the annual benefit statement for 2020. So again, that's really positive. So that's all I was going to say by way of introduction, Peter.
Okay, thank you very much. Are there any questions to Chris? Yes, Peter.
Thank you, Chair. I mean, many of us would have had the emails from those residents about ESG, particularly about fossil fuels. I'm sure a lot of us on the committee would have had the same email that was going around. I just wondered if Chris would want to give a comment on the risk number 13 on page 89. We've gone through this a few times in terms of that kind of balancing the risk between the investment return and ESG considerations. I just wondered if Chris wanted to comment on that.
Probably I think we were going to give an update on that on the letter that many of you would have received within the responsible investment item that Bhulesh is going to take later on the agenda. So it's probably, if it's okay with you, Peter, it might be best if we pick it up under that item. We can give you an update in terms of the response, and we can talk about everything we're doing in terms of responsible investment. But in a broad sense, you know, there shouldn't be a reduction in investment returns because we've taken our approach to responsible investment. In fact, in some extent, it should enhance it. So, you know, we don't see that there being a conflict between the two. But we'll give you an update on both on the letter and in terms of what we're doing in terms of our plan under that item.
Okay, thank you.
Okay, Nick.
Yeah, Chris. The issue, although sort of as per Ian's first paper about the government withdrawing their issues about the exit cap, I'm particularly thinking about the proposals, not the 95,000, but the further proposals that they were thinking about. Would that cause, if they reintroduced that, the government reintroduced that, would that cause an administrative problems for the fund?
If Ian's probably, yeah, Ian's still, I'll call Ian in a minute. Ian's still on the call, but I know that the pension section have done a huge amount of work just on looking at how we could adapt with the regulations as they were issued kind of before Christmas. So it would impact on the pension section. There's no doubt about it. But I think Ian can probably put a bit more detail on that.
Thanks, Chris. The answer, Nick, is yes. In simple terms, it will. But we're doing a lot of work in the background to ensure that that's as seamless as possible. The U-turn by government has kind of shelved some of that development. And I think the key point really, Nick, is around the system changes. There are significant system changes required to deal with those people who would be caught, who are under the 95k cap, but the redundancy element comes off the pension strain. So an element of the previously unreduced benefit becomes reduced. So that's the major technical system change, Nick. But in terms of the actual processes, we're bedding those in. We've got revised forms, and we're pushing as much of this through the employers as possible, because ultimately the employer has to initiate this, Nick. But in truth, as soon as the system kind of catches up, and we've also updated the modeler as well, so members modelers, when they run their own estimates, they'll be correct. We'll be in a position to continue as normal, but it will slow it down in the first instance. But I think there's a long way to go, Nick, on this, truthfully. Does that help, though?
Yeah, no, okay. I can just see if they reintroduced it as they proposed originally, I could see it causing an awful lot of extra work to your section.
And equally for employers, Nick, I think, to be fair, so, I think it will generate work at the employers too, to be honest, Nick.
Yep, no, I agree.
Is that okay though?
Yep, cheers.
Is that all right? Thank you.
Thank you very much indeed, Ian. Could I ask members if you can approve the revised risk register? Is that correct?
Agreed.
Okay, then if we move on to the next, which is the agenda item 10, responsible investment update. That's on 95 to 128. And Bulesh, the senior finance analyst, will give the report. We'll introduce the report anyway.
Good morning, everybody. Thank you, Chair. So the purpose of this report is to to give you some progress against the RI plan that we brought to committee last month and was approved then, and also to update committee on the quarterly voting report, which is included in Appendix A. So let's go for the voting report first. So we've got two elements there, starting on page 95. We cover off all our equity holdings. So I say all, and that includes LGIM, includes the three central funds we have now. So that's the Global Equity, the Global Emerging Markets, and the Climate Fund, and also an equity holding that we have with Pictet, our target return manager. So together, that's about 45% of fund assets. So we're getting towards half. We'll never get to the whole amount because we don't have equity covering off everywhere. So we've got private assets, for example, we've got debt and property, etc. So we'll never get the whole way there, but we're getting towards half now. Points 8 and 9 cover off the standard bits about how at those meetings we've voted or otherwise. We've also got Appendix B, which we reference on point 11 on page 96, which is Pictet's responsible investment report. They provide now, this is the second time we brought this to committee, their portfolios, carbon footprint, ESG controversies, and corporate governance indicators. And the report shows favourable performance versus the relevant benchmarks on their two carbon footprint measures. So it's a good report to read. So if you do get some time, have a quick look at that report. Normally, we'd also include a quarterly stewardship report from LGPS Central. They've just changed their reporting cycle. So we've got nothing this quarter. There will be another update due in April, so it will come to the next committee after that. There is a link on the paper on page 97. So if you do want to use the link, you can have a look at the back catalogue of all their reports on LGPS Central's website as well. The second part of this paper covers off our responsible investment plan for 2021 and any updates that we have. So you'll notice on page 97 the table starts. I've highlighted a couple of areas that are probably worth looking into. We've got in quarter 1 of 21-22, so by the June committee we'll have our TCFD report come through, and that we're working on that with Central as it stands. So I'm hoping by the June meeting we'll have that ready for you. We're also reviewing each of our external managers for their ESG capabilities, and you'll note that every time we do bring in a manager for any kind of presentation, we make sure that they kind of reaffirm to us their stance on ESG. And we do have Aegon later in the agenda today, and they'll be picking that up as well. And the last thing I've highlighted there is in quarter 3, we normally receive our climate risk report, or we did for the first time last year. We're moving that slightly ahead this year, so we're looking to bring that in another 6 to 8 weeks earlier. And the reason for that is that we can then use that report alongside the Hyman's SAA to see if we can build in any more of the responsible investing climate risk type stuff within the investment strategy for 2022 rather. Are there any questions on this report?
Well, before I ask that, could I ask Claire if you've got any comments to make on this agenda item?
Thank you, Peter. I think just in terms of linking it with the campaign on the fossil fuels again, which Bulesh will probably add in terms of what the fund's been doing to respond to some of the queries. I think both the investment strategy statement, which is earlier in the paper, that is the key strategy document in terms of outlines the fund's approach. And it's not to divest, and explaining the fiduciary duty owed to members and employers. I think in terms of the key elements of the fund strategy is to make sure the investment managers are considering all the risks associated with E, S and G, including environment and climate change, and the need to vote and engage. So I think this report is really about keeping on top of that strategy and monitoring it, how it's going. And the plan which Bhulesh and the team have put together over the last year and this year, I think is really just stepping up the efforts on that, ensuring the managers are doing what they should be doing, voting on the even reporting on the voting and making that more visible, but also being more conscious of which companies are the targets for engagement. And I know that's another element of the plan this year, looking back at the climate stewardship plan. So I think this is all sort of building up the fund's efforts in terms of managing those risks, which was mentioned earlier in the risk paper.
Okay, back to you then, Bhulesh.
I was just going to say I forgot to pick off the UK Divest letter, so thank you for reminding me there, Claire. Mr. Bedford, you picked up in the previous agenda item. And what we do have is a templated response, and we should be circulating that around members later today, hopefully, and we'll decide whether or not we need to stick it onto the website to possibly direct people there if need be. But there is a response written. We have picked up on the fact that some of the numbers that they quote, Platform and Friends of the Earth, aren't quite accurate for our fund. They've assumed a fair amount of there's a fair amount of estimates. They've only looked at 11% of the fund in detail, and they've assumed a fossil fuel holding for the remaining elements of our fund. So we'll stick that out to all members, and hopefully that will suffice for now. Thank you.
Okay. Thanks, Bhulesh, for that update. Are there any questions, Nick?
Yes, Bhulesh, I understand and I agree that the fund's approach in terms of engagement rather than divestment and use your voting power. But have you used your voting power on the remuneration votes to actually say, sorry, you haven't done this, therefore we don't support giving these directors their pay rises?
Yeah, I mean, it's one of the resolutions that gets voted down the most. Within the report, I think it's in Appendix A, you'll notice that it's for the 350 meetings that the fund voted against. Management abstained on over 3,700 separate resolutions. The majority of those were board structure, followed by remuneration at 21%. So, alongside board structure, remunerations is the next biggest one up. It's a serious thing, and our chair will probably back us up on the fact that from a central standpoint, when we have these similar discussions with central, we're very keen on making sure we're getting value for money.
Do you oppose the remuneration on environmental grounds, that companies have not done enough on environmental grounds, and therefore you're voting specifically on that?
That's a specific question, and that's probably one that I probably want to take back to LGPS Central. And you probably know that we do a lot of our engagement via LGPS Central and Hermes. So we can definitely take that one back and see if there is an answer for that. Okay,
if you can do that, thank you.
Are there any other questions to Bhulesh? No, I can't see anybody indicating. So could I ask the committee to note the report? Is that agreed?
Noted.
Agreed. Okay. So then we'll move on to item 11, the summary valuation of pension fund investments, as set out 129 to 162 in your report. Again, Bhulesh, that's for you to bring forward.
Thank you, Chair. Okay, so this is our standard quarterly report for investment performance of individual managers. We pick up a fair few other parts in it. So the first section now is a market performance and outlook. The first table there is kind of backward looking, and it's provided for information really, and we probably included this in the last 4 or 5 reports like this. It looks fairly similar to last quarter really. The same 3 have shown long-term performance over 10%. So you'll note there in the table on page 129. Property high yield, and gold have all shown double-digit returns over 20 years, and that bit hasn't changed. The next section is a section from Central's Tactical Asset Allocation Report, which is fully included as Appendix B, and it shows their views on asset classes going forward. So this is the forward-looking part, again, for information only. I note in point 4, we just bring out the major changes for the main asset classes. So for growth assets, income assets, stabilizing assets, the only real changes are, in their view, within growth assets, and they've upgraded 4 within that growth bucket, mainly on positive developments of the pandemic and vaccination programs, and we've seen that since mid-late November, improvements in equity markets and performance. We've seen that in our own portfolio also. So they specifically mention EU equities, private equity, global emerging markets, and Asia Pacific. They've upweighted those since the previous quarter. Point 5 and 6 just goes through our portfolio changes. So just a simple reminder on what we've done in the last couple of quarters. So point 5 talks about the 2 transitions we made in the last quarter in 2020. There was a £740 million move of assets from Legal & General, our passive manager, to LGPS Central's Climate Balanced Fund, and that was completed in December. We also, at the same time, almost in the same weeks, transitioned £100 million worth of emerging market debt investments from Ashmore to another LGPS Central fund, the Emerging Market Debt Fund. So a kind of like-for-like switch there. The benefit being we've gone from one manager to a multi-manager, and with far lower fees. Point 6 is a little reminder that just previous to those 2, we made some commitments to an infrastructure fund and private equity with existing managers for 25 million and 20 million. That was approved back in October, and we expect those commitments to be called at some point in 2021. Point 7 at the bottom of 130 is a quick note on cash holdings. Normally isn't in there, but we are holding more cash than we need for our future commitments at the time. It's a combination of our fund being cash flow positive. Also, we are awaiting new funds being launched by Central, so we're hanging on for a little while. And we also have a fair amount of money sitting with our currency provider, Aegon, as a result of the pound strengthening. So, we're holding a bit more money than we expect, but we are looking to utilise a portion, and there is a section on our agenda later today to use a bit of that, and we have earmarked a lot of this for the new launches with Central. 2021 investment plans is picked up from points 9 and 10. Point 10 on page 131 is an extract from the 2021 SAA. It's a reminder of what our new allocation needs to look like, and we're working to get towards that during this year. You'll note point 11 at the bottom of 131 looks at the 6 asset classes and the changes that we do need to get through this year to meet that plan. So that covers off private equity, targeted return, infrastructure, property, MAC, which is multi-asset credit or sub-investment grade credit, and then we've got global credit, private debt over the page on 132. So all of those mentioned there, we've got plans or irons in the fire where we are looking to either move to new Central products or use existing managers. The section on page 132 between 12 and 15 covers off the overall performance for the fund. So quickly looking through the quarter ending December 20, the fund delivered an investment return of +7 and +4 for the 12 months. It is lagging behind the benchmark by 3 and 1%, so 3 in the quarter and 1%. We do note that the portfolio evaluation report that we used to collate all our information had a couple of errors in it, and we've not had that back yet in time to get to committee, but we have adjusted for that, and if we do adjust for that, the return for the last 12 months isn't 4.4, it'd be 5.2. We are working with portfolio evaluation to kind of tie down their calculations, and ourselves back at the office will be checking their numbers a bit more thoroughly for the next few quarters. Point 15 looks at the fund's total value for the quarter. We're at 4.9 billion now. At the last actuarial valuation at March 19, the fund's valuation was 4.3. We're now 21 months into the 3-year cycle before, you know, we have to do a new triennial valuation. And, you know, we feel fairly comfortable at the moment. What we do have is our valuation at the time. So we can see that the fund is worth 4.9 billion. What we don't have at hand at all the time is the fund's liabilities. So to get a true view of where the fund sits in terms of its health, we need to be able to check the value of the assets and the amount of liability. We will probably look to do something mid-term going forward so that we can give a better kind of health of the fund. So, you know, we are just looking at half the picture when we just look at the value of the fund. We're looking through the rest of the paper there. We've got asset class performance review. So we're just breaking out what various asset classes have done. So points 17 to 23 run through equity, private equity, property and property performance rather. So I'm just going to pick up on page 133 and point 21. So it's just worth noting property performance has been mixed through the year. It mainly remains based on the kind of assets that we're holding. You know, if we've held a lot of retail assets within a manager, then, you know, those areas have suffered. So we've got Colliers who've got a fairly broad-based direct portfolio holding, so they hold direct property for us. They suffered minus 3.6% in the year, mainly due to them holding a leisure fund, which was obviously badly affected. You know, things like gyms, etc. You know, hardly any income, etc. We do have a large holding with LaSalle, which, you know, they are our largest property manager. They performed fairly flat in the year, so that's plus 0.2, and that's covered in point 23. We also have Aegon, and they're an active value manager, so they buy assets. We've got smaller investments with them, but they buy assets to develop and then sell on. And obviously, you know, the pandemic hasn't really helped with getting out there to kind of relever up these assets to make them more attractive to sellers. So that part did suffer. Points 24 to 30 on page 134 onwards cover off our 3 targeted return managers. Weirdly, all 3 managers had a very strong return in the final quarter. So it's fairly uncommon to get all 3 of them performing well at the same time. It's the reason that we've got 3 very different managers, so that if one isn't performing well, the other 2 will, for example. But all 3 performed well, and we had a total return in the quarter of plus 6.1. Incidentally, the full 12 months to 2020 also produced a return of plus 6.1, which is over the target we assumed for them by nearly 2%. And the standout manager there being Ruffer, who returned nearly 15% in the year. Aspect finished down nearly 4% in the year, and Pictet finished up plus 6% in the year. You know, in the first quarter when markets were really struggling, Aspects were flat, so we had a good performance with them. We can see that we've got the right split of managers there. When one isn't performing well, the others are, if you like. Pages 134 then talk about the detail for those managers, those 3 managers. I'll just pick up on page 135. We talk about Ruffer's holding in Bitcoin. You may or may not have picked up. If it has been in the press, you may have picked up on it, but they launched a small holding. I say small, 2.5% of their fund in Bitcoin, because they see it as a hedge versus the increasing supply in paper money, which will further weaken the faith in paper currencies, etc. And they normally held gold for this purpose, so they sold a bit of their gold, bought some Bitcoin, and at the time of writing, so after the December end for this report, they'd realised a fairly healthy profit and slimmed back down to 2.5%, and they're holding it as cash at the time of writing this paper. The last point on page 136 is a quick note on the currency hedge. It has benefited the fund over the year. You know, part of the reason that we do have a lot of cash at the minute is the fact that the pound has strengthened significantly during the year. I think in March we were down to about £1, $1.15. We're at 140, maybe a bit more as of today, and that's resulted in the fund holding circa 90 million with Aegon, our property manager. Our currency managers. Obviously, that will be offset by holdings that we do have foreign currency exposure with. And that's all I've got to say at the minute. Are there any questions?
Okay, thank you, Marlies.
Yes, just really to say how good it is to see Ruther returning. We had them in for investment subcommittee, over a year ago, when they'd entirely missed out, we felt, on the bull market, and we reduced our holding in it. And I'm finding it very encouraging that they are now back in the running again. That was really all I wanted to say. Thank you.
Yeah, they build an all-weather portfolio, so it's difficult for them to really outperform when markets are performing because they build in a lot of protection. So but their aim is not to lose money in any calendar year as such. So they've had a good year.
Claire.
Thank you, Chair. I want to give a few sort of high-level perspectives. I think the riskier assets have really done well over the last quarter. And particularly noticeable in the equity market. The stocks that we call value stocks, those that have typically been cheaper, have had a very good rebound, largely on the back of good news on vaccines. So we've seen in the total return portfolios, including Ruther, have done well. Some of their investments are in equities. So the relative return looks good from their particular. We're measuring them against roughly 1% over the quarter, and that value bounce has also helped the likes of Central that have that sort of tilt in their portfolio. I just, in terms of highlighting some of the particular numbers, infrastructure I think is a really interesting line on page 141 of the papers. It collates the infrastructure returns, and over the 9 months to the end of the year, the performance is looking at -7.5. Now, within infrastructure, there are lots of different types of infrastructure, and some infrastructure has suffered during the COVID, particularly the likes of airports. But generally, a broader, diverse portfolio of infrastructure we've generally seen doing not too bad. And I think that does make me question some of the numbers, particularly on the infrastructure. For example, the KKR number, we compare against the manager report, doesn't look right. So I wouldn't be overly concerned about that negative return on infrastructure. I think the infrastructure assets are doing what they should be doing and being fairly stable over the past year. So that was all from me. Thank you. Happy to take any questions on aspects of the markets or managers as well.
Okay, any questions to either Bullish or to Claire? No. Could I then ask members, can you please note the report?
Noted.
That's agreed.
Noted.
Agreed.
Noted.
Finally, we come on to the recommended agenda item 12. Onto the recommended investment, Aegon short-dated investment grade fund as set out pages 163 to 226. Members are aware we'll be discussing the contents of the public paper and then go into private session to discuss any supplementary information before we're joined by representatives from Aegon. We'll then ask them to leave the meeting so we can make our decision. So could you then, Bullish, introduce the public parts of the paper?
Thank you, Chair. So the purpose of this paper is to facilitate a decision for the pension fund to invest in the Aegon short-dated investment grade bond fund. So short-dated product for short, but the main parts are it's short-dated and it's investment grade, so relatively low risk in the spectrum of bond products out there. You'll note that the 2021 Pension Committee approved a target of 3% for investment grade credit. We are short of that target, and this paper is suggesting an allocation of 0.5% or 25 million. We do have a lot of cash, as we mentioned earlier. We've got 100 million sitting in the accounts, plus another 90 with Aegon. So the 25 million gets us towards the target. Points 6 and 7 go through why short-dated investment grade products. So just a bit of a background is the short dated products are defined as having less than 4 years to maturity. So that's the point when the capital is returned. The investment grade element for that name is the issuer's credit rating. So, you know, these are the credit ratings issued by the big agencies, S&P, Moody's, Fitch, and anything better than BBB on the S&P scale means it's investment grade. They have better capital preservation characteristics than longer dated bonds. We'll come on to that, and Aegon will pick up on that, and we do have a bit of training as well after that, you know, to just reinforce that kind of message. We note that the fund doesn't currently have a product between cash, which yields very little, and LGPS Central's investment grade product, which goes out further on the spectrum in terms of date. So you get a better return, but it's at the expense of a slightly higher risk. And so this product from Aegon kind of sits neatly in the middle, and the actual target for this is cash plus 1.25%. So cash being virtually zero, so the target is roughly 1.25%. Over the page on 164, we've got a little table on point 9 there, which kind of aims to illustrate what we're looking for. So you'll see cash that over there on the far left, getting circa 4 basis points or 0.04. Gilts with a negative return at the moment for 3 years, and you get a positive 20 basis points for a 10-year gilt at the time of writing. The important bits are on the far right there. We've got two instruments there, a Wells Fargo bond and a Western Power Distribution bond. You'll notice they're both short dated, so they're both mature in the next few years, so 2023. And you can see the kind of yields that you get there. You'll notice the yield pickup between having very safe stuff like cash to these short dated products is about 70 to 100 basis points there, you can see. So these are the kind of products that they'll be looking to fit into their portfolio. We have picked up with Central, and there is no similar product at Central to kind of migrate to. So that's why we're looking at Aegon. Points 11 and 12 talk about Aegon's fund management background. So the fund will be managed by two managers. They've got a long track record, and they're supported by a fairly extensive team. We talked to Aegon about their process of selection, their research process, and their ESG scoring of issuers. So even though they are a bond fund manager, they still look into the ESG aspects of the funds or the instruments that they'll be investing in. So they can look behind Western Power Distribution, and they can look behind Wells Fargo and see if there are any issues there, and they score them adequately. And I think we've included an appendix which has some detail there as well. Turning over, we've got on page 165 another table under point 14, which looks at 4 portfolios that Aegon currently manage. They've got a table there with 1 year, 2 year, 3, 5, and since launch numbers. It's just to demonstrate that they have been running similar mandates for other portfolios. And Portfolio B is another local authority pension scheme. The initial mandate was initiated with 5 years or less to final maturity. So fairly similar to this. We've got a 4 years or less. This is the Portfolio B is 5 years or less, and they've got positive returns as at December 20 across the board. Going over to page 166, we've got a table. Well, I can turn the page, which is effectively mandate characteristics. So you can see the kind of what they're allowed to invest in, and what the benchmarks are, and how quickly they price. So there's daily pricing, and they're the average credit quality of the shadow portfolio that they're running. There's 78 holdings in it currently, and the max weighting that they can have is 1.75% of the fund on a single issuer, and it's a fairly low duration. So you can see the last point in the table there is 2.6 years. So they're not long dated to the end, and the point of that is to cover off the 3 risks that exist for bond products point 18 onwards. So that's liquidity, interest rate risk, and credit risk. The first 2, liquidity and interest rate risk, are fairly low in the ranking for a short dated investment grade product. So in the short dated space, there's a load of liquidity, and there's circa £4 trillion worth of equivalent bonds. So liquidity is fairly high. You can sell in and out quite quickly. Interest rate risk also, given that they're short dated, they're not as exposed to interest rate movement. So the underlying holdings aren't very sensitive to changes. The biggest risk for any kind of bond product is credit risk, and that is addressed by their credit team effectively, and they've had no credit defaults in the time they've been running those four portfolios, and they've got a fairly good back office to cover that off with a team of credit research analysts, etc. I'm going to leave the ESG element on points 19 and 20 for Aegon to talk through. They could probably do a far better job than me, but just to point out that they do have an A+ rating from the PRI, the Principles of Responsible Investing, and so that they are ranked quite highly. They're first within managers for fixed income also. So we have picked that up with them. They'll pick it up again as part of the presentation. Moving on to the summary, kind of the things that we've already talked about. It's a lower risk product in an area of the market we don't have exposure at the moment. There's nothing with Central. It's looking to do cash plus 1.25% over a rolling 3-year period. They've experienced no credit defaults on a short-dated space since the inception of the four portfolios we've just talked about. Their fee structure is attractive, and we'll come on to that again later. And Hymans have noted it in their 2021 SAA that officers are delegated discretion to use the Aegon fund or any alternative fund reviewed and considered appropriate. Have we got any questions at this stage?
I can't. Tom, yeah. Sorry, Tom.
Yeah. Yes, please, Chair. The yield to maturity is indicated at 0.89%. How does that actually? What sort of charges are going against that 0.89%?
So that's saying that if you held every one of the 78 holdings to maturity, you'd get 89 basis points.
Yeah.
Some of those will be trading above par, which means that you can buy a bond at 105 pence, and then when it matures, you'll get 100 pence back. But in the meantime, you'll also be getting a yield every 6 months in the main, or 3 months, depending on the security. So as it stands, it's 89 basis points. Their target is 125. What they've tried to do is to buy and sell so that you can get a capital appreciation en route as well.
Okay.
Does that help?
Yeah, it does. I mean, I just wondered whether the charges outweighed the actual. I fully appreciate what you're saying about what level that presumably does that 0.89% include after charges then?
Sorry, I'd misunderstood it. So that
it's probably waiting for the charges to the private section.
It is.
Yeah, if you don't mind, Mr. Barclay, we'll just pick up that.
That's fine. Yeah. Fine. Thank you.
Okay, Marlies.
Yes, thank you. It seems, having read later on the Ruffler report, that this government is actually going to try and inflate out its debt. Therefore, inflation will probably take off over quite a short time. This is inflation negative to start off with, isn't it? So the pound, what we get back in 4 years' time will actually be worth less than we're putting in. Now, I don't know if there's an alternative, apart from, as Ruffler say, inflation-linked bonds. But should we be investing this money when we know perfectly well that the pound we get back at the end will be less than it is now? Thank you.
Yeah, it's a long-standing debate, that one, isn't it? Ruffler on what are very, 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 very on one side of the fence there, or one side of the spectrum there. You'll have noticed that other countries have printed to death, Japan especially, for example, and they've not seen the inflation, but we might be different. You're right that it might not be worth the same, but the point of this product is that you're not holding them all the way to maturity. You can trade in and out of them. The liquidity is so deep. They won't be holding something that they buy now and hold it all the way out. They can buy things which are only 2 years left. They can buy a product which has a 10-year life, but they're only allowed to buy it, when it's getting towards the end of its life, and the chances are they'll trade out of it when it seems appropriate as well. But I take your point regarding inflation, but it seems to be a hotly debated area at the moment, with bond yields, sharply moving up in certain areas of the market.
Right, thank you.
Claire?
Yeah, I just wanted to add to that. I think, given the themes of the strategy review that we had in January, and increased inflation and the risk of that was one theme. I think if we think about this in terms of the money currently is with Aegon in cash, so this is a slightly higher risk higher return expectation, because generally we are going to see lower expected returns going forward, which puts funding pressure. So this is just trying to eke out a bit more return to ease those funding pressures in future, albeit it's a small amount. So just to add to that perspective of inflation risk.
Thank you. Has anybody got any comments or question on this part of the agenda? No? Okay, could I thank you very much indeed. Could I ask then that you note, before we go into private session, 4th of June. So if you could put that into your diaries. Could I then just...
Sorry, Mr. Chairman, I seem to have cut out that last bit. 4th of June, what?
4th of June, 9:30, as usual. I suppose, since it's my last meeting publicly, I would like to thank you committee members for your patience and for your diligence in looking after the pension holders. But could I also thank the officers, both our officers and those our advisors, Claire, and those who are now with the central pool. Thank them very much indeed for all the work that they've done. They've been very supportive, and I look forward to the ongoing progress under new stewardship for the forthcoming years. Anyway, Tom, you've got something to say?
Yes, Peter, I fully appreciate this is your last meeting, and I just wanted to say a few words. As the committee will know, Peter was elected to the County Council on the 30th of June 1999 and has been chairman of the committee since the 22nd of June 2016. During Peter's tenure as chair, the fund has grown from 3.2 billion to 4.9 billion at the end of 2020, an increase of 56%, which includes the drawdown of the fund endured during the first quarter of 2020, so it would have been much more impressive. The fund, as at March 2020, has around 95,000 members, and the fund paid nearly 164 million in benefits in the year to March 2020. So this is not a committee you want to chair badly. Over his period as chair, I think one of Peter's key achievements has been pooling. He's a strong advocate for pooling, has worked hard to establish Local Government Pension Scheme Central. He's the longest serving member of LGPS Central's Joint Committee and Shareholder Fund Forum. In this role, he has been a real voice for shareholder interests, and in doing so has pushed for the partnership to be established on a sound footing. At times this has been difficult, and Peter has been willing to roll up his sleeves, especially in the storming and norming phase. We certainly know Peter is not one to avoid a problem. One final point, I think we would all agree that he has ensured business as usual for the committee despite COVID-19. In fact, viewing figures are up to over 200 members of the public watching the last meeting. Hopefully all of you will join me in thanking Peter for his chairmanship and wishing him well for the future. Thank you, Peter.
Thank you very much, Tom, and thank everybody indeed. It's been a pleasure. We're moving on now to the exclusion of the press and public. The public are likely to be excluded during the consideration of the remaining items in accordance with Section 100 of the Local Government Act 1972, exempt information.